Welcome to the debate. When structural engineers design a suspension bridge, they don't just calculate how much weight it can hold on a perfectly calm, sunny afternoon.
Right, that's the easy part.
Exactly. They model for the 100-year storm, the hurricane-force winds, the seismic shocks.
Yeah.
Because the quality of the engineering, it isn't proven in the calm. It's proven by its resilience when the environment turns actively hostile.
That makes total sense.
And today, we are applying that exact same engineering mindset to the architecture of financial data titans. We are looking at S&P Global, Moody's, and MSCI.
The big three.
The big three. And we are evaluating these businesses through a very specific lens, which is long-term, risk-adjusted compounding.
And, to be clear on that, when we talk about long-term investment quality today, we aren't talking about who can beat next quarter's earnings estimates by a few pennies.
Right. No short-termism.
No, we are defining it strictly in terms of practical business economics. A true compounder needs to consistently generate returns on invested capital well above, say, 15 or 20%.
Sustainably.
Exactly, sustainably. It needs to possess durable, almost toll booth-like economics, maintain exceptional resilience under severe economic stress, and, this is key, have a long runway for reinvesting cash.
Yeah, while demonstrating absolute discipline in capital allocation.
Precisely. We are looking for businesses that can take $1 of capital and reliably turn it into $1.20 decade after decade.
Which is incredibly rare. So we want to understand how these economic engines actually function under the hood. And looking through that framework, I take the stance that S&P Global represents the ultimate risk-adjusted compounding machine.
Okay, a strong claim right out of the gate?
Its business model uniquely blends two deeply entrenched moats, credit ratings and market indices. That structural diversification creates a shock-absorbing engine that frankly guarantees downside protection, while simultaneously funding massive, predictable capital returns.
Well, S&P is undeniably robust. I'd argue it sacrifices entirely too much organic growth to achieve that stability. I take the position that MSCI is the superior long-term compounder.
Really? Over S&P?
Yes. It is a pure play on the massive secular tailwind of passive investing. When you look at their 95.4% client retention rate and their unmatched organic growth, MSCI's reinvestment runway fundamentally outpaces S&P's more mature and frankly acquisition-dependent model.
Acquisition-dependent? Ouch. Let's unpack the actual mechanics of S&P's cash-generating power, because the sheer scale of it is what forms the foundation of my thesis.
Go ahead.
S&P is essentially a business that gets to make money twice on the exact same economic life cycle. I like to think of their model as a casino that owns both the high roller tables and the pawn shop next door.
That is a very vivid analogy.
They're low. Corporations rush to issue debt. S&P captures that boom through their ratings segment, which, generated roughly $4.7 billion in 2025 at an absurd 64% operating margin.
It is a massive toll booth.
They are the toll booth for debt issuance. But when the economy crashes, debt issuance dries up, volatility spikes, and investors pour their money into passive index trading to manage risk.
The pawn shop.
Right, the pawn shop. S&P captures that fear through their indices segment, which brought in about $1.85 billion at a staggering 69% margin. They win on both sides of the macroeconomic cycle.
Okay, you're pointing to the ratings and indices margins, but you are conveniently ignoring the massive anchor dragging down the rest of that ship.
Anchor is a bit harsh.
I don't think so. You have to look at the whole business. S&P's so-called diversification is actually just a mask for capital dilution.
Dilution? Come on.
Yes, dilution. Their market intelligence unit operates at a mere 20% margin. They acquired ISG, Market, for $44 billion to build out that data segment, and it is highly capital-intensive to maintain. It drags down their overall capital efficiency.
I think you're mischaracterizing the purpose of that unit, but
Let me just finish the thought. Compare that to how MSCI makes money. MSCI operates as a remarkably efficient asset-linked annuity. They don't just sell subscriptions.
right?
Their revenue is fundamentally tied to the assets under management of the funds that track their indices. They take a tiny basis point cut of the whole pie.
Wait, let's slow down and explain that mechanism because it's critical for the audience. You're saying that if I buy a BlackRock ETS that tracks an MSCI index, MSCI gets a direct cut of my investment?
Exactly. MSCI licenses its index to the ETF provider, and in return they charge a fee based on the total assets in that fund.
So they clip a ticket on the underlying value?
Right. So if global equity markets simply appreciate by their historical average of 7 or 8% a year, MSCI's revenue grows by 7 or 8% without them having to acquire a single new customer, launch a single new product, or spend an extra dollar on marketing.
It's an automatic escalator.
That is the magic of an asset-linked fee structure. In the first quarter of 2026, their index fee growth was over 26% year over year.
Wow.
And that isn't just a cyclical bump from a hot market. That is structural. S&P is tethered to mature, slow-growing corporate debt markets. MSCI is riding the structural multi-decade transition of global capital from active mutual funds into passive equity ETFs.
The secular tailwind.
Exactly. The quality of MSCI's growth and the runway they have to compound that growth is just structurally superior.
I have to stop you there because the switching cost argument regarding indices always confuses me. You're talking about MSCI's 95% retention rate and their incredible pricing power.
Unmatched pricing power.
But if a massive asset manager, let's say a giant state pension fund, hates the fees MSCI is charging, why can't they literally just track the S&P 500 instead? Or build their own internal index?
Because it is a logistical nightmare to untangle.
What mechanically stops them from leaving, though?
An index isn't just a list of stocks you can swap out. It is the foundational architecture of the modern portfolio. Imagine you are the chief investment officer of a $50 billion pension fund.
Okay, I'm the CIO.
For the last 20 years, you have measured the performance of your international equity managers against the MSCI EAFE index. All of your historical risk models, your performance compensation structures, your board reporting, it is all coded to that specific benchmark.
Ah, so it's deeply embedded in the plumbing.
Deeply. If you want to switch to an S&P or FTSE benchmark, you have to rewrite thousands of fund prospectuses. You have to get board approval. You break decades of historical tracking continuity.
Just to save a tiny fee?
Exactly. For what? To save a fraction of a basis point on fees. The friction of switching is so painful and the cost of the index is so relatively small compared to the overall assets that no one ever leaves. Asset owners literally build their entire multi-billion-dollar allocations around MSCI-specific definitions of what constitutes an emerging market.
Okay, that makes sense for the equity side. I'll grant you the stickiness there. But you are dismissing the exact same entrenched dynamic in S&P and Moody's debt ratings.
I'm not dismissing it. I just think it's more fragile.
Well, you criticized S&P's market intelligence unit earlier for dragging down margins, but you are looking at it through the wrong lens. Market intelligence isn't a standalone drag.
What is it then?
It is the data acquisition engine that feeds the 69% margin in the indices segment and the 64% margin in ratings. It's an ecosystem. Furthermore, you cannot simply swap out a credit rating. Let's look at how the issuer pay model actually works.
The controversial issuer pay model.
Controversial to some, but highly effective. If a corporation wants to issue $1 billion in bonds, institutional investors require that debt to be rated.
Sure.
The corporation paying for the rating doesn't actually care what S&P charges, because having that S&P stamp of approval lowers the interest rate the corporation has to pay investors. A $1 million rating fee saves them $10 million in interest payments.
It's a rounding error for them.
Exactly. S&P and Moody's aren't just data providers. They are regulatory mandated gatekeepers to global capital.
You just highlighted the exact fragility of their model, though.
How so?
The issuer pay model means the company issuing the debt, the one being graded, is paying the teacher for the grade. That inherent conflict of interest is precisely why S&P and Moody's face a permanent, existential regulatory cliff.
Oh, the regulatory boogeyman.
It's not a boogeyman. What happens if the SEC or European regulators finally decide that this model is fundamentally broken and ban issuer-paid ratings?
It won't happen.
But if regulators force a shift to an investor pay model, S&P's 64% margin is obliterated overnight. the pricing power evaporates because investors simply won't pay those astronomical fees just to read a credit report. MSCI doesn't face that kind of binary regulatory cliff.
I mean, a regulatory ban on the issuer pay model is a theoretical tail risk that has been debated since the 2008 financial crisis.
And it's still being debated.
Yes, but regulators have consistently concluded that the alternative, having investors pay, would severely limit market transparency because only the mega funds could afford the research. So the current model stays.
I still think it's a structural vulnerability.
But let's apply our engineering stress test to your thesis. Let's talk about a risk that isn't theoretical. What happens to MSCI in a prolonged, multi-year bear market?
The fees compress.
Drastically. If global equities drop 30%, MSCI's asset-linked fees instantly plummet by 30%. Suddenly, those mid-40s overall margins collapse into the 30s.
Well,
especially because MSCI has been aggressively building out their ESG and climate analytics ventures, which, currently operate at much lower margins, around 20%.
Those are investments in the future.
But they have high fixed costs in those new divisions. If the AUM revenue gets slashed, they won't generate the cash to sustain their massive valuation.
Look, a bear market absolutely compresses MSCI's asset-linked revenue. I won't deny that math.
Right.
But you are overestimating the damage and underestimating the resilience of passive capital. Even in a brutal recession, institutional money doesn't simply vanish.
It shrinks.
The assets shrink in value, yes, but the units, the actual shares held in the ETFs, they mostly stay put. People don't liquidate their entire retirement accounts en masse.
Fair point.
So the cash flow floor remains structurally intact, and when the market inevitably recovers, MSCI captures the entire upside without adding any incremental cost. Now contrast that with Moody's and S&P.
Okay, let's contrast.
If credit markets seize up and companies stop issuing debt, Moody's transactional revenue drops to near zero. 37% of Moody's revenue is entirely dependent on new deals happening. That is extreme cyclicality.
Okay, you're conflating Moody's specific vulnerability with S&P's balanced model.
They're in the same business.
Yes, but with different architectures. Moody's is like a single high-performance jet engine. It boasts an elite 51% overall operating margin, but as you said, it is incredibly exposed to issuance volume. S&P degrades much more gracefully.
How? The debt market is the debt market.
Because when a company issues a bond, they don't just pay S&P a one-time fee up front. They sign a reoccurring surveillance contract.
Right, the annual fee.
Exactly. That means S&P gets paid an annual fee every single year for the life of that 10 or 30-year bond just to keep monitoring it.
Which is a nice buffer, sure.
It's more than a buffer. Even if new debt issuance drops to zero in a recession, S&P still collects a massive river of cash from monitoring all the debt that was issued over the last decade. That recurring surveillance revenue, combined with their subscription data businesses, provides a massive $5.1 billion free cash flow base.
Generating cash is only half the equation of compounding, though. The real test is what management does with that cash. And this is where MSCI separates itself.
On capital allocation?
Yes. MSCI operates in secular end markets like the transition to passive management, the integration of private market data, and climate risk modeling. They have a massive reinvestment runway to deploy their capital organically.
And S&P doesn't?
S&P's organic growth is stuck in the mid-single digits because the corporate debt market is mature. When your organic growth is that slow, you are forced to rely on financial engineering to compound.
I wouldn't call it financial engineering.
That is exactly why S&P bought IHS Markit. That is why Moody's has accumulated massive amounts of goodwill on its balance sheet from buying up smaller data firms. They are mature businesses buying growth to mask their fundamental deceleration.
You are framing capital allocation as a weakness when it is actually S&P's greatest strength. Let's look at the history of their management discipline.
I'm looking at it.
Going all the way back to former CEO Doug Peterson and continuing with current leadership under Martina Chang, S&P has a proven, decades-long track record of ruthless pruning.
Pruning, sure.
They don't just buy assets. They are highly disciplined about selling off non-core, lower-margin businesses. They sold off J.D. Power. They sold McGraw-Hill Education.
Which were smart moves, I'll admit.
They deliberately stripped the company down to focus exclusively on highly scalable, high-margin financial data. And they used their excess cash for massive, predictable shareholder returns. Over $15 billion in buybacks and dividends between 2023 and 2025 alone.
But look at the governance structure driving those decisions. MSCI is founder-led. Henry Fernandez has been running the company for decades, holding a combined chair and CEO role.
Which some would say is a governance risk.
I disagree. Bureaucratic, mature companies like S&P shuffle assets around to hit quarterly EPS targets and appease Wall Street. Founder-led governance provides the patience and visionary alignment required to build durable franchises over decades.
So you're betting on the visionary.
I'm betting on his track record. Fernandez recognized the passive investing wave before anyone else, and now he is positioning MSCI to be the toll booth for global climate transition data. Yes, I will concede that MSCI carries relative leverage.
Quite a bit of leverage.
They have about $6.45 billion in debt as of early 2026. And the valuation is undeniably a premium. They trade around 33 times forward earnings.
Which is incredibly steep.
But you pay a premium for structural, secular growth. I would much rather own an expensive, founder-led company riding a massive global tailwind than rely on a mature company's ability to perfectly integrate its next multi-billion-dollar acquisition. That reliance on a founder's vision is exactly what introduces valuation sensitivity, though. S&P's multiple is far more grounded because the business doesn't require a visionary to run it. The modes are institutionalized.
Well, institutionalized can also mean stagnant.
Fair enough. But let's step back and synthesize the landscape we've mapped out here today. When you look at the raw financials, the differences in absolute profitability are wide. I mean, Moody's leads the pack with those 51% operating margins.
Right.
But when you look at actual cash conversion, the ability to take those accounting margins and turn them into tangible free cash flow, the differences between S&P and Moody's are quite narrow. The core trade-off we are debating isn't about whether these are good businesses. They are all elite.
Exactly.
We are debating the specific flavor of their superiority. Right. S&P deliberately sacrifices peak cyclical growth to achieve extreme dual-engine stability. MSCI sacrifices downside margin buffers and valuation safety to capture explosive secular optionality.
And that structural difference is why I remain convinced that MSCI is the most compelling compounder for the next decade.
Because of the optionality?
Yes. If the trend of passive investing continues to capture market share from active management, and if ESG and climate analytics become mandatory compliance layers for institutional capital, MSCI's reinvestment runway is simply unmatched.
Assuming the trends hold?
Right. The sheer friction of their network effect ensures that every dollar of asset growth translates directly into highly predictable, sticky cash flow.
And I maintain that S&P Global's unmatched balance of two mission-critical moats, getting paid to rate the debt and getting paid to index the debt, combined with their ruthless capital discipline, makes it the ultimate compounding machine.
The sleep well at night option.
Exactly. It possesses the diversified economics to survive the economic storms and the cash generation to reward long-term patience without requiring you to overpay for future growth.
It really comes down to what we might call the AUM growth dynamic.
The deciding variable.
Yeah. That is the single variable most likely to dictate which of these stocks outperforms over the next 10 years. It is the relative flow of global market assets. If capital continues to surge into passive equities at an accelerated rate, MSCI's basis point fee model will mathematically drive it to the top.
And on the flip side, if that passive wave stalls, or if we enter a lost decade for equity appreciation, then S&P's balanced recurring surveillance model wins.
Yep.
It circles back to our structural engineering analogy from the start. You have to decide what kind of architecture you are building for your portfolio. Are you optimizing for the highest possible capacity during the long economic expansions, accepting that a storm might compress your margins?
Or are you optimizing for the deepest structural integrity, demanding a business that mints cash even when the financial system is under severe distress?
Well said. There is no perfect architecture, only the trade-offs you are willing to live with.